What if I told you that some of the biggest real estate deals in America are now being funded by your grandma's life insurance policy? Apollo and Blackstone and KKR have all turned boring old insurance companies into rocket fuel for massive commercial real estate bets. This is the promote from 1031 Media. I'm Hiten Samtani. Here's the story of how Wall Street's biggest players cracked the code on infinite money and may have fundamentally changed how real estate lending works in the process. Let's break it down. So here's the problem keeping private equity bosses up at night. As Apollo's co-president Scott Kleinman put it, the single most important factor for an alternative asset manager is origination capacity. That is the single biggest constraint on growth. That's why, he added, we've been so focused, some might say maniacally focused, on really making sure we're building the right type of origination in the right volumes. Let's translate private equity speak. What he's saying is these firms had all the deal flow in the world, but kept running out of money to lend. Private credit, which is direct lending to companies and real estate projects, was absolutely booming, but it has one nasty problem. It gets rated like junk bonds, which means massive capital requirements that eat into your profits. Meanwhile, traditional banks were retreating from commercial real estate lending thanks to post-GFC regulations and a collapse of the regional banks. And now someone needed to fill that void. Private equity saw an opportunity. Then Apollo had a light bulb moment. What if we bought insurance companies? Here's the genius. Insurance companies collect a bunch of premiums today, but don't pay out claims for decades. That's a massive pile of money. We're talking trillions just sitting there earning meh returns in government bonds. So Apollo buys Athene in an $11 billion deal in 2022 and goes ahead and completely reimagines how insurance works. They create a financial perpetual motion machine. So what you do is you take the equity that falls out of insurance assets, you use it to create private equity funds with outside investors, then you leverage that money to build debt origination platforms. Much of it goes into real estate. The investment-grade debt from these platforms feeds right back into the insurance companies, creating more equity, funding more origination, and creating more debt. I know it's complicated, but that's how it works. Financial alchemy, turning insurance premiums into an endless cycle of fee-generating deals. These are the quiet kings of capital operating behind the scenes. The numbers here are staggering. A third of the $6 trillion US life insurers hold was tied up in private credit by the end of 2024. That's $2 trillion that used to sit in treasury bonds that's now flowing into private deals. Apollo plans to raise another $10 billion in insurance money via an SPV that's going to let them bypass the junk ratings problem we talked about. Blackstone struck a $20 billion partnership with Legal & General. KKR bought Global Atlantic. All the big boys are now seeing the playbook. And look, asset-backed debt like commercial mortgages meets investment-grade criteria that insurance regulations require. Your retirement savings now directly compete with banks and CMBS to fund office towers, apartment buildings, shopping centers, and industrial. Now look, LifeCo companies used to typically tap out at the $200 million range. Now though, because of these structures, they're writing $500 million checks or more and going head-to-head with traditional CMBS. Take 590 Madison Avenue in Manhattan, for example. When RXR needed to close quickly on the purchase of that tower, it wasn't CMBS they tapped. Apollo's Athene swooped in with a $650 million senior loan. Deal done. And this is happening everywhere. Multifamily, industrial, office, you name it. These insurance-backed lenders have become some of the most important players in CRE finance. Something deeper is happening though, and it speaks to how financial engineering is able to break free of traditional constraints. Financial markets traditionally were designed to allocate capital to productive enterprises. But increasingly, the system focuses on funding retirement instead of growth. We're witnessing what my friend Hunter Hopcroft called the end of savings. Instead of Americans putting money into stocks, which funds new businesses, they're buying annuities, which prioritizes safe returns. The result? Capital markets become subsumed by demand for debt securities. Instead of taking equity risk on the next Amazon or IBM or Nvidia, money flows into asset-backed lending, collateralized by music royalties, GPU clusters, shopping malls, and more. This creates a system that feeds on itself rather than funding productive growth. Apollo calls this replacement, replacing public equity with private, bank lending with private credit, traditional savings with insurance contracts. PE firms have created the ultimate perpetual motion machine. Insurance equity generates private credit capacity, generates fees, funds origination platforms, creates investment-grade debt feeding back into insurance companies, and this creates more equity to just do this over and over again. But the question isn't whether this continues. With retiring baby boomers demanding safe returns, that's inevitable. The question really is whether finance feeding on itself can coexist with risk-taking that drives real innovation. Your grandma's life insurance policy, well, it might fund the future skyline, but is it funding America's future? Hope you enjoyed this breakdown from The Promote. If you did, please smash that subscribe button and share this with anyone who you think might be interested. Also check out thepromote.com for more CRE Insider goodness, and tune in to the Promote podcast for commercial real estate's essential conversation. Thank you so much, and see you next time.